Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Tuesday, June 11th, 2019. I wanted to get the video out. I want to point out some levels. I was going to put up a few charts, static charts on the site, and the more I went through, I wanted to include this one, this one, future, SPY, QQQ. When it gets to be too many charts, that's actually, believe it or not, quicker to just do a video and wrap that up. And I can also convey my thoughts. Let's just start with levels to watch. Here's that SPY 60-minute chart. 289 was really the what was my uppermost bounce target on SPY. Popped it yesterday, but remember we came back and tested it. We also took out this potential uptrend line. That's the better draw right there. It comes right off the low on that candle. So we broke that, hit the 289 support, back tested it successfully. Two different 60-minute candles here. So 1, 2, bounced up, back tested the trend line from below, and now we're already back there. Well, what does that mean? Well, a couple of ways to look at it. You can, in trading, you can always look at it glass half full, glass half empty. The glass half full says, well, it's that level's holding, and it has. So let's just be very clear on that. And, I always say support is support until that's broken. It hasn't broken yet. But what happens is usually on a healthy breakout, and this isn't always, just usually, you come in, if you're going to backtest a level that you've taken out, an important level, it's usually a one and done, especially if you've sat there and backtested for a little while and started to move away from it. The fact we're already back to it tells me that this rally keeps getting sold into, and that at least in the very near term here, the buyers may have dried up. So again, we don't have a sell signal unless 289 breaks, and the reason I'm doing this video is because this isn't all there is. There are other indexes to watch, and they may be at, and they are actually, as I'm doing this video, at support. And so you want to see all of those break to put the odds in your favor. If you're already short like I am, like I said, I'm not adding unless that level goes, till we start to see a reversal here. I'm very fine with the shorts I have now. They're I do see comments in the trading room, and my goodness, guys, I can just say again, use the position size calculator. Don't put all your eggs in one basket. That means don't put them all in one trade. The markets were up about 1% today. If you're feeling pain on a 1-2% move against your position, then you have too much. Unless you're day trading, but if you're swing trading and you're shooting for, who knows, 5, 10, 15, 20%. Like I said, on the QQQ trade, I have the possibility of a 25% or more downside with obviously some other near-term targets. So when you look at it that way, you can easily expect your position to go against you, 5% or more. Again, if that's your target, if you're shooting for 20-25% downside, if you're only shooting for 10% downside, maybe a 3% stop loss, that still gives you a little better than a 3-to-1 risk reward ratio. And I'm pretty sure we haven't even exceeded that on the QQQ trade. But with that being said, trade and do what you're comfortable with. The old rule, or the old saying on Wall Street, is sell down your position to the point where you can sleep at night. So if you're not using a position calculator, if you're just winging it, and whatever you're in, if it's making you uncomfortable, use that rules. And if the selling down to the point of no position is where you're sleeping at night, then that's where you need to be in cash. All right, so here's SPY, level to watch. If we break that, that will be a failed breakout of that level, and it was a pretty important level. It wasn't just an arbitrary level that I listed here. You can see we had this. We had a breakout right here. That was back then a breakout. We back tested it successfully for several days there, several days. Started moving up, came and back tested again, came and back tested again. That made that very good support. Not only that, so it's well-defined support, and this is just basic chart technical analysis. I get a lot of questions. How do you draw levels and trend lines and support and resistance levels? So you had a support level there. A breakdown was a sell signal, and the fact that we came in and back tested it, not once, but look at all these back tests, look at all these candles, multiple attempts, and it failed. As I always say, support once broken becomes resistance, and that even further validated or strengthened this level, made it a more significant level. So we ran up to it the other day, we popped it, and we broke out. So like I said, on face value, until and unless that breakout fails, it is bullish. I'm leaning towards a failure of it. I made that clear. But if we start to do this, I won't fight it. This is where I start to scale out if we go up a lot much higher than this of those short positions. So, and if we do break it, as I often say as well, fewer things in trading and investing are more bearish than a failed breakout. So that's what I'm looking for on SPY. Let's look at QQQ. QQQ, we are in this trend line, let me just tell you, is not very significant because we only have 3 reactions. In my book, it takes at least 3 reactions. There's the first one, there's a little green candle in there kind of hidden by the volume bars. Another reaction there, and now a third reaction. Because I always say this, any 2 points can be connected at random so I get that third reaction to make it a valid trend line. Let's see what happens. And more importantly, you had that 183-ish resistance level, and that was pretty significant as well on QQQ. It popped, and we back tested it. Let me zoom in. Yesterday, same thing, 2 candles, and we're coming back down at it again. Now we haven't broken below it, and I have more of a resistance zone. It was a support zone that runs down from about 182.93. We'll call it again 183 down to about 182.25, and that would be important. That's also the top of the gap from yesterday. There's a gap right there. There's that flag pattern, and so if the gap gets entered, it'll probably be backfilled. That takes us to the top of the flag. And so as I said yesterday, each of these, if and as they break, it is a check mark for the short case. It means our short's looking better. It's increasing the chances that this was a failed breakout. You're going to break this trend line, and it should usher in some selling. So it hasn't happened yet. I think it will. But again, if it does what I don't think it does, excuse me, I'm sorry. If the market does what I don't think it's going to do, then I'm wrong, and then I need to start be concerned about exiting those positions. And again, that will be on a move over 185. It's not an all or none thing. I scaled into those positions. I will scale out. And I also want to make very clear, just because we pop 186 doesn't mean all of a sudden my outlook goes from bearish to bullish, or my positioning or anything like that. Trading's not black and white. If the risk reward was attractive for longs, I would consider reversing my positions, but I don't believe it is, so I would be out, getting out of those positions on that break and continue to move up. But I wouldn't necessarily be going into index longs for many reasons. All right, so that's the daily charts. I'm sorry, the 60-minute charts. Let's look at futures real quick. This is NQ. These are the Nasdaq 100 futures. Sometimes I get the question, why do you often cover the futures? Well, you can pick up a lot of nuances and or technical developments you don't get from QQQ, because QQQ, you're looking at trades that go from 9:30 a.m. to 4 p.m. Eastern time. The futures trade virtually around the clock. They only shut down briefly each day for to square away positions, and so you're going to have a lot more candles and reactions, and you can see how well defined this trend line is. Look at all these reactions. Again, these are 60-minute candles. I'm counting dozens of candles touching that, either the body and or the wicks, the skinny part below. So point right now, what stands out the most, I guess the most salient point on this chart or feature at this point in time is the fact we're pulling back to that trend line, a lot like QQQ. So we have the Qs, SPY, just about everything testing pretty significant support. This is an important trend line, and it is these divergences that tell me that we're probably going to break it, and that's why I'm still leaning towards a failed breakout scenario. Had we not had these divergences here, I would say, TA 101, Technical Analysis 101 says you buy pullbacks when you see a trend. You buy pullbacks, go long on pullbacks to support. However, when you get to the point where there's enough in the charts that tell you that trend is most likely coming to an end, instead of looking to position long on a pullback to the trend line support, I instead wait to position short, or in this case add shorts if that level goes. And of course you have then 74.82ish just below is a pretty good level. So what I'm doing is going down the line here, and all these index ETFs or the futures are either at support, and as I mentioned, SPY recently, or ES, just even yesterday broke down below its comparable uptrend line. You can see it right here. Nice clean uptrend line, breakdown, back test, and that back test, although it was a new high, it was only it only extended the existing negative divergences that were in place at this high. So we're pushing up a series of 3 highs, each of those just simply expanding the divergences as they even you can see the lines continue to steepen or diverge even more. So the divergence is becoming more powerful, and we already have the failed breakout above 2900 on ES, and we have the trend line break and back test. So ES is actually looking, you already have basically a sell signal, is what I'm trying to say on ES. But until you see the NASDAQ breakdown as well, you want to see that confirmation to give you the highest probability. Whether you're not already short and planning to add, whether you're currently long and you're concerned where to take profits, where to stop out if the trend has changed, or you're short and you want to add to those short positions, again, you'd want to see QQQ and NQ breakdown as well. So large caps aren't the market, but they do make up the vast majority. By far, the bulk of the stock market is made up of large cap stocks. You covered them pretty much all there in S&P 500 and most of them. And you have the small caps, of course. They don't move the needle as much on the overall stock market, but it's a tradable index. These are small cap companies, 2,000 of them. And that's the Russell 2000 futures right here, and you can see right at a nice clean trend line, which again also forms a bearish rising wedge, as I've been pointing out. So there's your setups right here, and these wedges are confirmed with divergences, which you want to see, and so there it is. So we either bounce here, get another reaction off there, or we break down, and that could be the end of this counter trend rally. We'll see. That's what I'm still leaning towards. Nothing has changed recently. We're kind of pushing the upper ends of where I thought this bounce would go, but that's fine. That to me, if my scenario plays out, that's actually great, because we had was able to scale in and add at those highs and get some a good cost basis on those short positions. So right now, sitting tight. And I will add and only add on strength. Some traders will, typically it's the retail traders, will continue to average down on a losing position, thinking they're lowering their cost basis, which technically they are, and I'm talking about a long. Let's say you're at a long position. And I'll do that, but only when I have a predetermined plan to scale in between a certain range. And I do that. If you wonder, well, why would you scale in instead of buy at a certain level? Again, it has to do with the confidence of where I think something's going on QQQ. So if you recall back what was it, a week, 2 weeks ago, I think, where was it, I can't remember exactly now. I think it was 178 up to 183 was my preferred scale in zone. And because I didn't know where this, it was hard to gauge exactly where this thing would end. And again, it overshot by a little bit, and that's fine. So I kind of had a buffer there where, again, it wasn't all or none. Just stop scaling in, no more, adding to those unless we come back down. So we're in that kind of neutral zone, let's call it. And this is where, again, above 186 is where things start to really chip away at the bearish scenario. All right, so those are the levels I'm watching, and I guess I should give you IWM because I know a lot of traders out there do not use futures. So here's what IWM looks like on a 60-minute chart. Again, these rallies were very well telegraphed in advance, or at least indicated by these divergences here, just like we had. Same thing, it's wash, rinse, repeat stuff. Bullish divergences back here led to this rally, that divergent low. That divergent high led to that correction. Divergent high led to that correction. This was a divergent low, led to this rally. So as of now, we have a trend line break there in IWM. But again, RTY I showed you was sitting right on its trend line. So let's say I was trading IWM. You might want to, at this point, just give it a little more downside, let the futures break, and that's a higher probability sell signal than just this trend line break. We also broke that, that's minor support, but it's support worth mentioning, about 151.11. So maybe just a correction, a blip before another leg higher. Or what I favor is the beginning or the end of a counter trend rally with, the end of a counter trend rally in a correction with more downside to come. Something will look like this, that being the first leg down off the highs, counter trend bounce, and another leg down to come. Okay, I'm going to wrap it up here. We have price targets for QQQ. I may add TVIX. I'm going to tell you I like it right now, and I like it because the risk reward is good. We're at the upper end, upper threshold of where I figured this bounce would go. So here's the thing: I'm going to be right or wrong. So you go with something like TVIX or any of the VIX ETNs, and don't get married to it. Keep your stops relatively small because again, if we just push up another 2-3% from where we're at now in the markets, then kind of give up on that short case, at least for the time being. Sometimes that happens. Look, and it'll go up and push over my upper limit. I close all my shorts, then you get a big reversal. I'll jump back in. To me, it's no big deal. I've done that many, many times. Just underestimated a bounce or a pullback, and was positioned for it, got stopped out, but then boom, if you get a big reversal stick or high probability evidence in the charts, I'll get right back in the trade. So, and with TVIX, what I was saying is you can go with that. If we go up much more, you stop out. Yeah, I think I already gave you guys targets on this in a recent video. Here it is, and I almost added it this morning. I still may add this one, but I'd have to sharpen this up. This one's been traded through. Yeah, let's just say right here, first target 33.90, then 43, and then 61.17. And quite possibly more if the longer term bearish scenario plays out and the market's got another 20-25% or more downside from here. But right now those are targets. So to quantify it, you say, okay, well, what do I do with that, Randy? Let's say I like it. Well, all right, let's say you're just going to go, you want to hit get a single or a double, not try to hit a home run right now, just, get on base, and you want to just take a shot up for that first target. That's a 51% return. So a 3-to-1 risk reward ratio would give you about you could take a 15% or 16% downside, and that would put you a stop right there where the crosshairs are, about 1865. That's the previous low, so right around that previous low. Again, 16%. Well, you might be saying, Randy, that's crazy. How can I risk 16% of my money? It's very simple. It's what I call beta adjusted position sizing. It's a term I made up, but it's just basically says, look, if you're taking something with that high beta, high volatility that can swing, this thing can swing double digits in a day, and often does when volatility spikes. So if you are shooting for that 50% return and you're going to give yourself a 16 or 15% down stop, then just take a 1/3 position size, for example, and that turns a 15% stop loss into what is comparable to a 5% loss on a normal trade, which is for a swing trade. At least for me, that's fine. And meaning you're going to lose the same dollar amount you would on a regular trade, a regular size trade, with a 5% stop loss. Likewise, yeah, you're cutting your gain down as well in total dollars, but you're still getting, what is that, 1/3 of 50%. So it's it cuts both ways. Anyways, that's the answer to the question, where a 16% stop is insane if you're taking not insane, but pretty heavy for most traders if you're taking a whatever your typical position size is. And what I'm referring to, a typical position size, it's SPY, for example. SPY's the market. So if you take, whether you take 5,000, 50,000, whatever your position size is in SPY normally, cut that down by, well, in this, I'm just using a quick example here, 1/3. And that helps you control your losses in dollar terms. Percentages are irrelevant. It's dollars. You're not going to go broke on a certain percent. You're going to have $1,000 and take a 15% loss. It's not going to kill you. So it's all about the total dollar loss. All right, we're going to wrap it up here. I want to get those levels out to you guys ASAP in case the market takes them out and starts to move. I think it's a powder keg right now. If that bearish scenario is going to play out, it'll probably start to play out quicker than most expect. So that's the thing. It's either going to play out or not. But if it does, and you're just, let's say, 2, 3, 4 days late in getting in, because you wanted to see that evidence, you may have missed the boat. Now, why? What makes me say that? Well, let's just go back here real quick, and then I promise I'll wrap it up. I showed you these counter trend rallies before. I showed you these two yesterday being even a little larger than the one we just had. Well, from the point we topped right there, just the first 1, 2, 3 red candles, 3 red days took us down 5.2%. After this one, we topped here and the very next day, just in one day, we closed down 4.38%. Here's what happens. The people that there's two types. There were those that were bullish and long buying there, and they don't even care to short. Then there are those that wanted to short but just didn't. They wanted to see evidence of a reversal. Well, when do you know the trend's over? This was just a little down day. It was the next day that was much bigger. This one you gapped down and you went quickly. So what happens is these reversals tend to leave most traders out, even those that want to short. And I'll tell you, the trend traders, the ones that use the short-term moving averages, like a 5-day moving average or whatever, they get whipped to pieces in these kind of markets. By the time their trend indicators confirm that the trend has changed, you've missed half the move or more, and it's no longer objective to short after you've dropped 5, 6, 7% in 3 days. For a move that's probably going to go 8 or 9%. That's just my style. So that's why I try to position at tops and bottoms. Sometimes you get stopped out early, but you tend to catch bulk of the move. And then also, if I have positions by scaling in on these where I think the top is coming, it gives me a core position which I'm more comfortable adding to. If the market were to gap down 3% tomorrow, I'd feel a whole lot better adding some QQQ shorts on versus not having any position and starting there, because a 3% gap down could be bought up and then they ramp it back up and you're immediately underwater. So that's just my style. Yeah, so let's wrap it up here, and I'll get this video out to you guys. And like I said, I'll consider that TVIX as an official trade, but official, unofficial, if I didn't like it, I wouldn't pass it out there. I just don't have the highest degree of confidence yet, because there's just not evidence of decent evidence of a reversal yet. One sign would be to take out yesterday's candles. We did in SPY. That's pretty bearish right there so far. QQQ, we got a little work to do. All right, guys, let me wrap it up and get it out to you. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.